Hi everyone, welcome back to Be Rich. It's just me again in the studio. Shashwat is back, heading to Bangalore, and I guess I'll remotely record with him tomorrow or day after, depending on his schedule. Anand seems to be getting ready to go to Bangalore too on some work, so he's not in the studio today, so it's just me. So, what am I going to talk to you about today? Well, this is old folklore in investing. It's called the 60-40 rule. 60-40 rule is the concept being that 60% of your investment should be in equity in stocks, the 40% should be in the bond market, in the debt market. And this is a very old method of investing, which a lot of people still use. I want to dive a little bit into it and see, does it work? Does it make sense? Is it something that you should be doing today? People have been using this strategy where they put 60% of their money into stocks and 40% into bond. Even big old BlackRock, a big investment company, talked about this 60-40 strategy. They said when a stock market drops, bonds can help balance things out. In 2002, an expert named Peter Bernstein said that the mix is a good balance between high returns and low risk. Some people wonder why we still use these old strategies. What comes to mind is a story about a girl, and the legend is that her mother used to cook a slab of ham, and every time she used to cook the ham on the stove, she used to cut the end of the ham off and cook the rest of the ham. So she asked her mother, why are you cutting the end off the ham and not cooking the whole ham? She says, I don't know. My mother used to do this, so I do this. So then the girl hopped across to her grandmother's house, who lived down the road, and asked her grandmother, why did you teach my mother to cut a bit of this ham off and waste it and only cook the rest of this? Why you waste? So her grandmother told her, I don't know. My mother told me this. So the girl again got up and went further down the road to her great-grandmother's house and asked her, why do you cut this bit off the ham and taught this to your daughter who taught it to my mother? Now I see this happening. Why do you cut this? Or what is the logic behind wasting half the ham? So her great-grandmother smiled and said, well, I had a very small pan to cook in. So the whole piece of ham didn't fit, so I used to chop it and only cook what I could. So this is what seems to be the folklore behind the 60-40 rule. Then a lot of people use this strategy. Maybe it's outdated like the ham story is, I don't know. So that's why I've got some graphs. If you have invested in the US market from 1966 to 2022, the graph gives you various mixes of 100% bond, zero equity, all the way to 100% equity, showing various divisions of the mix. And looking at how 60-40 strategy performed in the US, it seems to be a good starting point. If you invested $1 in 1960 using this strategy, you would have around $204 in 2022. This strategy is a good risk and returns balance. Though the origin of this story, 60-40, seems to be a bit of a mystery. Some think it started way back in the 1950s because stocks did well then. Others think it might be tied to some old finance book from the 50s and 60s. A reporter even said it started in the early 1960s. No one knows. But in conclusion, if you see this is an old strategy and might have been braving dividends way back in the 1950s and 60s. But if you look at it in the long term, if you see the kind of returns equity gives, it outperforms. Maybe it is something to look at if you are having a shorter exposure in the market and you're not looking at the long term. But if you're going to be in the market for 20, 25 odd years or plus more than that, like someone like Kesava Karthik who's behind here, he plans to be, let's say, in the market for 30 years. He's like, I'm going to keep investing and forget about it, and I'll look at when I retire 30 years from now, that's going to be my nest egg. And that's the strategy. I would say it's better off to put in the Nifty, keep sipping up the Nifty, and not worry about too much of this risk, reward, return, whatever you want to call it. So if you see in the long term, again, I've asked Dylan to put up the graph now. So even in India, if you see, traditionally we may look at, say, this is the Western outlook, this is an American outlook. In India, we look at gold, real estate, fixed deposits, other ways to hedge our bets, and they've been historically favored in India. If you're talking about the old grandmother story in India, our great grandmother would be saying, don't put it in equity, don't put it, just buy gold, and if you have more gold, then buy some land. Keep buying land and keep buying gold, everything will be hunky-dory. We know that that doesn't hold water and it's not true anymore. That the rising middle class of India with increasing financial literacy, the Indian stock market and bond market has gained a lot of popularity now. And the 60-40 rule might have initially also been very popular here in India. I'm sure way back, if I can recall, it was there, spoken about way back when we were thinking of investing, when I was much younger, the 60-40 rule. But however, in recent years, the equity market experiences some rapid growth. And tilt towards diversifying investment is there. But I would say if you are in it for the long term, the 60-40 rules and all these things, whatever, they seem to be either from a time when it is not relevant anymore, or it is something gimmicky. 60-40 is not gimmicky, I should agree to it. It is a great way of balancing risk and reward. But the way Indian stock market is performing, and if you're looking into the long term, it just makes sense. You get much better rewards if you hold on to it in the index for a longer period of time. I know you're risk averse and all this only matters in a very short breadth of time, like I said. And if you stay in the Indian market, even that risk disappears because you get a compounding rate of growth of around 10 to 12%. Some even say 13% in the Nifty. And that's more than enough. It beats inflation quite handsomely and rewards you very well. And if you keep doing this. So this is why I want to talk about 60-40 rule. So one of you had mentioned it on the Instagram or in LinkedIn, I'm not sure where, saying, "Sir, what is the 60-40 rule? Do you recommend it?" And I looked into it and I said, no, this is why I wanted you guys to see the graph, because the graph, the proof is in the pudding more, as they say, more than me ranting and raving about it. You can actually see numbers behind this and see if it's really something you want to do. Well, that's what I had for you today. I hope you had a wonderful day today, and I'll see you in the next one soon. Thanks for being with me on Be Rich today. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.